Beth Spikes.
I'm Kelly Joyner, and we are with Berkshire Hathaway Home Services.
And Chad Cutler.
And Josh Ignoski with American Wholesale Mortgage.
Hey, we're going to talk to you guys today about different types of loan programs and what's good for you, what it takes to get each loan program.
Sounds great. Let's do it.
Awesome.
So how many different types of loans are there?
There are a ridiculous amount of types of loans. However, most people will end up really focusing on about 5. FHA, conventional, USDA, VA, and then there's something called jumbo. That's where most people are going to fall. Very few Americans are going to hit the jumbo category simply because the price points are going to exceed $453,100 for at least Georgia. Georgia has one county, Greene County, that exceeds that amount as their county loan limit. So a county loan limit ultimately states that the majority of all the people living in that county are not going to buy a home that exceeds that dollar figure. So nationally, we have these lenders that come up and say, okay, well, if most people are not going to buy above that point, we don't need to lend above that point, and therefore we set these limits on our loans to meet those county loan limits. So if someone's trying to buy a home above $453,100 in the term of the loan, then they would fall under the jumbo category, and then that's private money, meaning it's not typically backed, or it's not backed by Fannie Mae or Freddie Mac. Yeah, so we'll stick there.
What about FHA? Most people hear FHA, USDA, conventional. Most people are like, hey, FHA is just for a first-time home buyer.
That's not true. You just can't have more than one house with FHA. So it's not necessarily a first-time home buyer, it's just someone who wants to buy a home and only own one home. That's a government program. The same thing with VA and USDA. Those are government-backed programs. So, as with anything, if you're going to be backed by a government program, you have to file your taxes, you have to pay taxes if you owe them. You can't be behind on government loans, i.e. a student loan or an existing government, loan that you might have. So it's very important that when you're dealing with the government, that you are not currently owing the government and then hoping that the government's going to give you a house note.
That's true.
So what would the requirements for FHA, USDA
As
loans?
far as like what do you have to make, or what does your credit score have to be, just so people know going in?
That's a great question. So USDA really has these boxes, and USDA has a family income limit, at least the guaranteed housing, which is what we offer. We offer a guaranteed housing portion because USDA has 2 different portions. But we use the guaranteed housing. And so if your family size is like 6 or 7 or something like that, you can make something like $84,000 a year. But if your family size is 1, you can't make more than like $40,000 a year, something like that. And USDA posts this stuff. So you can go on to USDA's website and you can look up single guaranteed housing, and then you can find income limit, and then you can actually identify whether or not you meet those income limit guidelines. Now, I don't ever encourage anyone to underwrite their own loan, because more people will tell me, oh, I'm not going to qualify for that. And then after we look at their tax returns, we look at how they write things off, and we go, no, actually you do. And we run it through the system, we send it to a lender, the lender reviews the whole loan, and sure enough, they get it. So I don't want anyone being, a superhero with their own loan if this is not something they do on a daily basis.
Yeah.
Just like I would never go to my mechanic and ask him about medical advice. It's just not going to happen. I would love him to diagnose my car, but not my Colt.
Yeah.
Right.
So that's kind of how that works. So going to someone who knows exactly what they're talking about is very, very important. Just like they're relying on you to give them real estate expert advice, they're going to ask us for that same mortgage expert advice. So let's go back to the FHA now. Now, is there an income limit to use FHA? The answer is no. You make $1 million and get an FHA loan. There is a maximum loan amount though, and that's based on your county loan limits. So ultimately, if you're making $1 million and you're trying to buy a $600,000 home, FHA is going to disqualify you from that product because the maximum you're going to be able to buy is $341,000 or whatever the case may be. So maybe you're putting 200-something thousand down and using FHA. That's fine, but you can't exceed that FHA loan limit. Now VA is the other government program that everyone who is vet, active military, reserves, National Guard, they fall into that category provided they have met the criteria. And so with some of these, it's number of hours that you've been in the military. If you were discharged early, was it honorable? Was it medical? There are certain ways to utilize VA. And VA, by far, is the best loan program in America. And I'm so glad to be able to offer that to our veterans and our active military. With that being said, they match the county loan limit to 100%, provided your entitlement is zero. Or, the full entitlement. If it's not your full entitlement, if it's zero, then we would have to reinstate your entitlement. And we'll go into all of that with your client, but that's something that we do with them. Long story short, we also offer a VA jumbo loan. So that means if you've got a veteran, and we had one a couple of months ago, that, I think on a $600 and something thousand home, he brought $20,000 to the table, which was nothing. I mean, you think about a jumbo, most jumbo products are 20% down. So on 600,000, you bring 120 to the table, not 20.
Yeah.
Right.
So, and the interest rate was ridiculously low compared to what a jumbo is going to offer, because jumbos are private money. They can offer whatever rate they want. So, long story short, the benefit to the VA, and I really encourage any of your watchers, if they have the option of VA, utilize it. It is a blessing for a reason. No private mortgage insurance, even though they put zero down. The VA prevents the veteran from paying the attorney fee. They prevent the veteran from paying certain fees in general. Now, things to be aware of, the veteran is buying on a well, or FHA, you have a well, or USDA, you have a well. They're going to test that water. That water's got to be tested. And it's got to be done by a third-party independent company, and the results have to come back where it's, acceptable. Now, there are some communities that use what's called a shared well. Are you familiar with that?
Yes.
See? This is why they're real estate expert advisors. So a community well is going to be serviced oftentimes by a third-party company that reports those things to the county on a monthly or quarterly basis. Those results have to be provided. So if you're buying in a subdivision that has community well, that's what's going to happen. And that fly is going to bother me.
We have a visitor.
We do.
If we swat, you know why.
I mean, we're in an old home, living on a farm type of deal. Flies are
It's gonna happen.
That's right. So,
The other question we get a lot is down payment assistance. You hear about it all the time. There's a loan for everybody, you can get down payment assistance, but is it really that easy to get down payment assistance?
it's a process. So if you really need it, then you're going to be taking classes oftentimes. You're going to be supplying a lot of information up front to prove that you actually need this. 9 times out of 10, it's for a first-time home buyer, someone who's never owned a home before. and they're gonna vet you, because ultimately what they're doing is they're, in most cases, like I believe the Georgia Dream is one of those.
Yes.
They're putting what's called a silent second on the back of your loan. So you don't owe it as long as you keep the house, and I believe it's for 5 years or something like that. You've got it. There's a duration of time that if you tried to refinance the home or sell the home, that you would ultimately have to pay that money back. And I actually bought my first home using something very similar to that, but I was not aware that I had this second mortgage on the back. And a year later, the interest rates dropped, so I went to refinance. Well, I owed all that money back, and I'm going, what in the world? Why do I owe this money? And they're like, well, you used the down payment assistance program. And I'm thinking, well, I just used the $100 down program because I was a new father, a new husband, had a low income job. We were just trying to make ends meet, and we were living in a tiny 1-bedroom home with no dishwasher. I mean, you name it, it was bad.
Headliner fell through on the
Yeah. And I'm just going, golly, let me use this program. And so I did, but when the interest rates dropped, I wanted to utilize lower and lower interest rates. And so having to pay that money back was a shell shock at the time, because all the savings I was getting from the refinance was being eaten up by having to pay back this down payment assistance program for having done so within that time period. So it looks good, and the grass is always greener on the other side situation, but it's not always the best if you're not going to stay in the house for a long period of time, because you go to sell the house thinking you're going to make all this money, and you don't. You end up having to pay it back. So the nice thing is it's not built into your payment. It is legitimately deferred payments. So you don't pay anything. There's no interest. That is not a program that American Wholesale offers, only because as a broker, we do not contribute to, or we do not use lenders that contribute to that program. So part of that is it's not all just government money. It's the lenders that are contributing to that down payment assistance in hope that they're going to receive the loan on the back end. So that's why you see people who go, oh, who does this down payment assistance? Not everybody, because you're putting money in,
Yeah.
and then you're hoping to get that money back, and then you're hoping that that person stays. For a lender, there's a good 18 months before they're profitable on a loan. So if you refinance out of that in a year, there's no money to be made. That's why they get their money back, essentially.
Right.
So
See, that's good information to know, though, because a lot of people out here watching are like, hey, we can get down payment assistance, and it's great, we can get money, and we can get the house, we don't have to put anything down. Well, maybe not on the front
there
end,
are
but
some more catches
yeah,
to
there's
it
a
that
lot
you
more
need to be
catches
aware
to
of.
yeah, and a lot of these lenders are gonna pigeonhole into a particular program. So the truth is, 3% down, you can get a gift. You can pull it from your 401k as a loan and pay yourself back. You can save the money yourself, or if you have it already somewhere you just can't use. That fly
there's
loves
the
you.
fly. I did shower this morning.
You didn't name him.
So that the money that you can never use for a home purchase is money that's stashed under your mattress. If you can't prove where it came from, you can't use it. And that has to be money deposited by your employer as a deposit for your check for that week or 2 weeks or month, however you get paid. It has to be a gift, check from the donor, proving that that donor was the one who supplied it. It can't be, hey, I need $10,000, Mom. Mom goes, let me go to the safe, pulls out 10 grand in cash, and you deposit into your account. That's untraceable funds.
Yeah.
So we don't know how you got that. I like to tell this to every single client that I ever talk to. If you tell me, I have to prove it. If it's on the application, I have to prove it. So if you tell me in your application, you've got $30,000, I need to see it in a bank statement. I need to see it for a bank statement for 60 days. I need to know that you didn't just go deposit that from underneath your mattress, or you pulled it out of your safe deposit box and you put it into the bank. Because yeah, I have a lot of clients that do that. During the recession, they took a lot of their cash out and they put it into a safe deposit box. And they left it there. And now all of a sudden they want to buy a house. So they're going to go pull it back out and deposit it back into the bank. It does not work like that. It's got a season. You need to pull that money out, put it into the bank, and then 60 days later, then you go shopping for a house. Because I need to see that that money had been sat in that account for the past 60 days. Well, why is that, Josh? Well, what if you owed back taxes? And the IRS came and they took that money, because guess what? They can do that. They can siphon that stuff right out of your account. You owed back child support. The state comes in and pulls that money out of that account. So the lender wants to know, hey, is there anything fishy going on? We're trying to skirt something, and then we're going to buy this house. Well, then all of a sudden, the state comes in and liens the property for back child support. The federal government comes in and liens the property for back taxes. So, a couple of things. We're coming into October. Anyone who filed an extension by October has to have paid. They have to have filed for 2017. That's really important. You're not getting a loan after October if you haven't filed your 2017 taxes. So we need to make sure that we're filing our taxes. If we owe, you're going to need to make sure that you pay. The fastest way to pay, IRS allows you to pay online.
Yeah.
Just pay it online. Don't send a check.
No.
Do not mail in your tax return. Don't mail in your tax return. Take it to the IRS office and have them stamp it. I don't care what your CPA says. They're not lending you money. You're trying to get a loan. Go to the IRS. Get them stamped. It says received. It gives a date. It's awesome. Lenders need that. They need that. They need to see that it was actually received by the IRS. When you do it electronically, there's no receipt. When you mail it in, there's no proof. We have to wait until the transcripts have been received, or some lenders will wait until they show proof of the payment. So that's the easiest and fastest way. If you want to make your loan go quick, just follow my advice. People who are concerned about their credit, things to that nature. We were talking about the credit report itself. So let's say I pull the credit in May, I'm looking at a snapshot of what their utilization was, derogatories were, whether or not they opened any new accounts or they closed any accounts in April. So utilization is if I have a card with $500 on it and I use $300 on it, for example, I used a percentage of that $500. So I use 60%. So if I use 300 out of the 500 available, I use 60%. Now, a lot of clients go, well, my balance isn't that today. But the credit agencies don't know that because they only get a report once a month from the creditors. They go, well, I paid it in full. That doesn't matter. The creditors are not actually letting the credit agencies know your payment. They only show whether or not you paid. So they say, hey, this client used 300 out of 500, which is a 60% utilization, according to the credit agencies, because the agencies don't care the number, they only care the percentage, the utilization percentage itself. And then they say, did they pay their payment or not? Yes, they did. No, they didn't. Oh, if they didn't, were they 30 days late, 60 days late, 90 days late, 120 days late? How late were they? And then they would let them know. So then the credit companies take that information and say, oh, they utilized 60% of their available balance. They're a high risk. Let's score them appropriately. Now the next month, let's say you didn't use anything in the month of May, and I pull your credit again in June. June is a snapshot of May now. Because remember, I pulled it in May and I saw a snapshot of April. Now I'm pulling it in June, I'm looking at a snapshot of May. That's how people's scores change from month to month, because all those creditors are now reporting the new balances. So let's say we paid $300 because we had used $300 and I didn't use any of it in May. So when I'm looking at it from June's perspective, I'm seeing a zero balance now. Well, my utilization is now 0%. Woo, low risk. So now my credit score rises. Here's the misconception. I pull your credit in May and see a snapshot of April. Then I use more. I don't actually pay it down. I go out and spend another $200 on that card. Now my card's maxed out. Or maybe a collection hit that I didn't know about. Or maybe I missed a payment and you pull it again in June. Now all those creditors have updated their information. The credit report now sees utilized $500, missed a payment, something hit collections. The client doesn't see that. The client sees my score dropped. What happened between May and June? Oh, you pulled my score again. It must be because you pulled my score. No, it's because they updated your information. And the information that was reflecting in April is now different in May. So when I pulled it in May, I'm looking at April, and now I'm pulling it in June, I'm looking now at May. And a lot of people do this. They'll go open a card. Well, he told me my credit was good. I thought it was worse than that, so I went out and bought something. Well, then I was at the register. They offered me 10% off if I just opened a store card with them, so I did. And then I realized how much of a credit line I had. So I was like, let's go shopping. So I stepped back out of line and I went shopping for more stuff because I thought I needed it. Now I'm realizing I really want a house, not that cool pair of sneakers. And I can't get it. So that's kind of how that goes. And unfortunately, there's not enough education that teaches people that the credit pull itself is not really what's hurting you. It's how I spent. It's how I borrowed. It's whether or not I paid my payments on time. It's whether or not something that happened 6 months ago just caught up with me, and now all of a sudden I have a collection that I didn't know about. You know, did I pay the hospital bill? A little birdie, and I'm not taking any credit for this, but a little birdie told me that as long as you make a payment to the hospital, and the hospital accepts it, they can't report you. I can't verify that. I'm not going to claim that. I'm just saying that that's what I've been told. Maybe that's true, maybe that's not. Make the payment.
Make your payments. Now, what if people have credit cards that are sitting there with zero balances on them and they're like, hey, we want to buy a house, we need to close all these out. Is it better to leave them open, close them out?
That's a great question. There's something called strength of profile. So when a lender is looking at your profile and they just see like 2 or 3 cards with zero balances, you haven't really paid anything over the recent months, and you're really trying to go to like 50% of your debt to income ratio. You don't really have any strong payment like an installment loan. So let's look at value of debt. A mortgage is going to be your high value of debt. Your car is going to be a high value of debt. A store-only credit card, like something that exclusively can only be used in that store, that's going to be low value of debt. Like our credit company is going to look at that and go, they can only shop there, there's no real value, we're not going to score them very high for paying back a store-based credit card. Something that can be used anywhere, that's going to have a higher value for your debt profile. And much like a seesaw or a weighted scale where you would put something on this side and something on that side, let's say I have one trade line, credit card, car note, whatever, and I'm paying that one thing on time every single month. But then I have 16 collections. Which part of the scale is really heavy? It's all the collections. So yeah, you need to take care of that, or you need to have more strong things over here that can outweigh the negatives. Now in Georgia, we have a 7-year wait, a 7-year max for debt collection. So if you've got a debt that's about to fall off, that hasn't been collected on, just understand that if you've been haunted by a collection agency, that collection agency most likely is going to sell your debt right before your 7-year mark, so that it starts your 7 years over again. And that's unfortunately how the industry works. So a lot of people are like, oh, I don't even need to pay that. It's about to be the 7-year mark, it will fall off. No,
Sold.
that's going to be sold. And then your 7 years is going to start over again. Now, if you paid it, if you settled the debt, and you can do that, you can settle collections for less than the amount owed. You may or may not receive a tax liability for that as unearned income for that year, but you don't necessarily have to pay the debt in full, because remember, the company that you were initially indebted to sold that debt. They wrote that off as a loss. So now the debt holder is, they may have bought it for 10 cents on the dollar. So if you pay them $1 for the dollar, they made 90 cents on that.
Yeah.
They're making a tremendous amount of profit. And of course they'll tell you, oh, you gotta pay the whole thing, you owe it all, and you go, well, I didn't sign it up with you. Well, we bought it, it's our debt. Okay. Well, how much have you collected so far? Well, nothing. Great, that's how much you'll continue to collect, unless you settle with me. Because here's how much I've got, here's how much you ask. That ain't adding up. So that's a possibility. I don't want to be sued by anybody, but that's the truth. I mean, you can settle collections if you want to. Understand that your 7 years will start over from that period, and then at the end of 7 years, that collection will fall off your credit, unless they change the credit rules. So,
Yeah, that's one of those things we hear all the time is, I don't want multiple lenders pulling my credit, it's gonna mess up my credit, and we try to tell people
Yeah.
that's not how it works. It's not like you go buy a car and it sends it out to 25 different people that are gonna do hard inquiries on your credit and
well, even that's going to be considered one inquiry, is my understanding, based on the Fair Credit Act. So, and that's the benefit of us being a broker. We pull your credit once, and then we reassign that credit pool. So the lenders aren't re-pulling the credit with whichever lender the client selects. So we reassign that credit pool. So technically, I've got 7 lenders with 1 credit pool. Whereas at a car dealership, they are sending the application to individual banks, and each individual bank is pulling it. But again, my understanding is, as long as you're inside of one industry, you can have your credit pull as many times as you want within 30 days. This way it gives everyone a fair opportunity to try to buy that business through, incentives, either, closing cost incentives or lower rates or whatever the incentive might be to try and win that business. I say buy that business is really win the business. So,
like with you guys, what would be your, say you've got, because we deal with a lot of first-time home buyers, your first-time home buyer comes in to talk to you. What are the documents that they need to have together? And like, what would be, if you were gonna say this makes a good first-time home buyer, what would that person look like?
they breathe.
They breathe. I mean, that's a good start.
That would
Everybody
be,
out there breathing, they're good to go.
Please breathe.
I can't do something for a dead person, okay? A first-time home buyer or not a first-time home buyer, anyone who is responsible and can prove that they can repay the debt is who we are looking for. Because every single loan is structured the same way, whether it's for hard money or it's for a conventional loan or it's for a jumbo or a government-based loan. The only time it's not structured that way is if it's a loan from your mom or dad, or someone who's willing to give you their personal cash and say, hey, I'll be a private investor, I know who you are, I know you're good for it, I don't need any documents. And there are people out there who do that. It's called owner financing, and they do, still probably pull credit and probably ask for a large down payment. But for people who aren't in that position, and a lot of people aren't going to owner finance, and a lot of people don't have mom or dad that's got the money to pay the house in cash and go, you know, congratulations, yeah, pay me back or don't, it doesn't matter, you're my kid. We have to do what's called ability to repay. We've got to prove that that person, and you don't even have to have a credit score in most cases. We have lenders that will do no credit score loans. They're very difficult to get done. This is not like someone who has established credit. Because remember, a credit score means I've been paying, or I have proof that I've been paying back someone else. So they can look at that history and go, yes, they are a good risk. And that's what a client is. Any customer is a risk to a lender, because a lender is fronting money and then giving them a duration to pay back. And 30 years is more risky than 10. That's the case. That's why a 10-year interest rate is offered at a lower rate than a 30-year. Okay? And your credit score is a representation of a number of your ability to repay, your risk level. The lower your score, the higher your risk. And in anything, you see this in cars. When you call up an insurance company and they say, well, we've got to run your driving record to see how you do. Well, why are you doing that? Shouldn't everyone get the same insurance rates? No. You have 17 speeding tickets, 3 crashes. We've totaled out 7 of your cars in the past 5 years. We're going to rate you accordingly. Or your risk is too high, move on to the next insurance company. And that's the same thing with mortgages. If you've got a bankruptcy with a foreclosure, you're currently late on your debts, but you make great money, doesn't matter. Clearly, you're spending it on other things.
You're not responsible enough to pay this back.
Yes, than the other debts that you currently are delinquent on. And I've had that. I've had people making 6 figures a year that just simply don't pay their bills on time. For whatever reason, and everyone's got a reason. Well, I was in the Bermudas for the past 6 months enjoying life. Well, why didn't you set up auto pay? No clue. I was on a boat, living the life. Okay, must be nice, but unfortunately you can't get a loan today. You know?
Maybe next year.
Yeah, maybe next year. So, long story short, the ideal borrower is someone who's responsible. Doesn't matter race, color, gender, sexual orientation, I don't care. As long as I can prove that you can repay the loan, that's all the lender cares about. Because we're equal housing opportunity. It doesn't matter to us. We want to put someone in a home today, tomorrow, next week, next month, next year. And we will walk them through how to get there. But the categories are income. That's how we're repaying the loan. That's how we're proving it. If you're self-employed, you need typically 2 years of business tax returns and personal tax returns. If the debt's owed, you pay it. If you're getting money back, we want to see that you've received that money. We want to see assets. A lot of loans, especially with lower credits, you need reserves. You need 1 or 2 months in case anything goes bad. You're able to make that mortgage payment for 1 or 2 months. They're hoping you're going to get on your feet in 60 days or less, right? On top of the down payment. If you've got great credit, you don't really have to worry about reserves so much unless you're going jumbo, but they're going to look at your credit score. They want to see, do you have a credit score? They want to look at your credit report. Do I have current lates? Did I have lates in the past? Something happened. Write an explanation letter. Hey, bad things happened in 2013. This was the economy crash. Lost my job. Company went out of business. That's why I have a bunch of lates. That's why my credit score was really, really low back then. I couldn't buy. But this time around, and 5 years in, I've been positive. I mean, every single payment's on time. I've cleared up a lot of the negatives in my past. I fixed the issues. And we have a lot of those. We have a lot of clients who do have history 7, 8, 10, 12 years ago where they had to file a bankruptcy, where they had to give up a car. And we're getting those loans done now because they've righted the wrong. They fixed the issue and they're proving it on paper. Remember, whatever I say on my application, I have to prove in documentation. And that's a lot for some people because they go, well, can't you just trust me? No. The lender doesn't trust anyone. Well, I do make 100.